Okay, so let's get right into it. We're going to break down the absolutely fascinating story behind Applovin's latest earnings report. It's a story where a company is posting unbelievable numbers, but the market is kind of freaking out. And it all boils down to one central paradox.
So, the company we're talking about is Applovin, a huge force in mobile tech. And on February 11th, they came out with news for Wall Street that, well, on paper, looked about as perfect as you can get.
And I mean, look at this. They didn't just squeak by Wall Street's expectations. Nope, they blew the doors off. Analysts were already expecting big things for their Q4 revenue and earnings, and Applovin just flew right past those numbers.
But then, things got weird. Right after dropping this bombshell of good news, the stock didn't shoot for the moon. It fell. And not just a little bit, a pretty significant drop when everyone was expecting a party.
So what gives? That's the big question, right? The paradox we're going to dig into. Why on earth would a company that's firing on all cylinders get punished by the market?
Okay, so to really get what's happening with Applovin, you've got to realize this isn't the same company from a few years back. Not even close. They've pulled off one of the most aggressive and, frankly, successful pivots we've seen in tech lately.
So Applovin started out as a big deal in mobile games, but this timeline shows a complete change in strategy. They smartly bought up key ad tech, and then, get this, they sold off their game studios to become the super lean, asset-light software company. They basically decided, hey, instead of digging for gold, let's sell the picks and shovels. And their AI engine, Axon, that's their high-tech shovel.
And boy, did that move pay off. This transformation created an absolute financial juggernaut. The numbers they put up this quarter are, well, they're kind of hard to wrap your head around.
First up, revenue. A whopping $1.66 billion in just one quarter. And this wasn't just them barely hitting their target. This was a huge outperformance.
And get this, that number is 66% higher than the same time last year. You know, in the world of big tech, seeing growth actually speed up at this scale, that's almost unheard of. It just screams massive, massive demand.
Okay, now this number is just nuts. An 84% adjusted EBITDA margin. Let me break that down for you. For every single dollar that came in the door, 84 cents was basically pure operating profit. That's just an absolutely elite, top-of-the-class level of efficiency. And all that efficiency, it turned into cash, a ton of it, almost $4 billion in free cash flow for the year. And remember, this isn't just some number on a spreadsheet. It's actual cash they can use to buy other companies, buy back their own stock, whatever they want. It's a massive war chest.
You know, the company's own management said it best. They called their situation a combination of sustained hypergrowth, exceptional margins, massive free cash flow generation. Essentially saying, yeah, we know, what we're doing here is incredibly rare. They know they're playing a different game than almost anyone else.
So, we're back to the big question. With numbers this good, why the heck did the stock drop? Well, because for all its strength, this juggernaut is running straight into a huge wall of worry.
So here's the deal. Investors are looking at those amazing numbers on one hand, and on the other, they're looking at these three big risks. There's a serious SEC investigation, lingering questions from short sellers, and just this general anxiety in the market about how AI could disrupt everything. And that SEC investigation, that's the big one. As one expert put it, this could be a, quote, watershed moment in how regulators police the multi-billion-dollar mobile advertising ecosystem. Basically, a lot of people are watching this very, very closely to see how it plays out.
So what's it all about? It boils down to this term, identifier bridging. The core question is whether Applovin's powerful AI works its magic by connecting your user data across different apps, say from Meta to TikTok, in ways that platform privacy rules, like the ones Apple put in place, were specifically meant to stop.
But even with that scary-looking wall of worry, the pros on Wall Street, for the most part, they are still super optimistic. The bull case is alive and kicking.
I mean, just look at this. You've got 25 analysts who cover Applovin full-time. And of those 25, a whopping 21 of them are telling investors to either buy or strong buy the stock. That is a powerful consensus.
And they're not just whispering buy, they're shouting it. Their average one-year price target is way up there at over $680. That suggests the average analyst believes the company should be valued more than 50% higher than where it was trading. That's some serious conviction. Some analysts are even more direct.
The team at Stock Story just straight up called it a no-brainer, arguing that it's a rare opportunity to buy an elite, high-quality company for what they see as a bargain price, despite all the noise.
So this all brings us right back where we started, to this central conflict, the core paradox that anyone looking at Applovin today has to wrestle with. You've got two powerful, competing stories. It really comes down to this clear bull versus bear story. On one side, you have this unbelievable financial performance that puts Applovin in a class of its own. On the other, you have these huge external risks that are just impossible to ignore.
And that leaves us with the ultimate question. The company has proven its technology can generate absolutely incredible results. But the market is asking if that same technology can overcome the serious questions surrounding it. The answer will likely determine if Applovin can really become a true, long-term challenger to the giants of digital advertising.